So a viewer recently emailed me and asked a straightforward question. He said, Rob, I use the bucket strategy. I know it's not what you do, but it's it works for me. But I need some help. I'm having some trouble modeling the bucket strategy inside of retirement planning software like Bolden. Can you just walk me through how to do it? And it turns out that question is far more complicated than you might think. So what I want to do in this video is look at the practical side of managing the bucket strategy. And I want to start first with just trying to understand the bucket strategy in sort of our real world accounts, like 401ks and IRAs and taxable accounts. And then we'll talk briefly about how we might think about modeling that inside of a retirement planning software, and what I think is probably the single biggest challenge of doing that, regardless of what software you use. So let's dive right in. I want to start with the two bucket strategy, and I'm just going to draw it out. This was developed by Harold Avinsky. He's retired now, and that's my drawing of a bucket, by the way. He was a financial planner in Florida. I interviewed him on the show. You can find it in the channel. And his bucket strategy was very simple. He had just two buckets. This first one was cash. And when he started, what he did with his clients is he put 2 years worth of cash in that bucket. And then everything else, stocks, bonds, the investment portfolio went in bucket 2. So primarily, I guess, stocks and bonds here, or ETFs, right? And whatever allocation. So we'll just assume 60% stocks, 40% bonds. And that was it. Very simple. And the way these two buckets worked was that once a quarter, he would move money from bucket 2 into bucket 1 to top it off, to bring it back up to 2 years. The client had spent money for 3 months. Maybe their expenses changed. I don't know. But he moved whatever he needed to over to bucket 1, and then he rebalanced. He would always rebalance quarterly. And that was it. Pretty straightforward. Now, it turns out that as simple and straightforward as that is, it sort of masks some real complexity underneath. And what do I mean? Well, first of all, let's start with cash. This probably is fairly straightforward. What do the real world accounts look like that make this up? Well, folks are probably going to have a checking account, maybe a high yield savings account, or a money market fund for, one of these maybe for emergency. They'd put maybe a year and a half or some amount into those accounts to get some higher interest. They'd keep a few months of money in the checking account for spending, but that would be it. Pretty straightforward. But what about bucket 2? Well, here, we could have a taxable regular, brokerage account. We could have an IRA, and if you have a significant other, you might have two. You both could have Roth. Well, or if you have a significant other, both have them. You might have money in an HSA, or two of them, right? You could have an inherited IRA, or two of them, or even more than that. So the point is, this looks real nice and easy. We got our little bucket that we've drawn here. I've put 60-40 under it. It looks simple. But, whoops, get rid of that. In the real world, there could be a lot of complexity. And the reason that matters, among other things, is that when we make this quarterly transfer, or if you do it once a year, same thing, you got to decide where this money's coming from. And here there are sort of two things to consider, right? One is taxes, because depending on which account you draw from, there are going to be different tax consequences. And inside a taxable account, depending on which specific investment you pull from, there could be different tax consequences. And then we also have to just think about our asset allocation, right? This 60-40 here. And so these are some important decisions. So even as simple as this bucket strategy is, there's still a lot of things to think about when you move money. Now, in some cases, it might be easy because maybe you have interest in dividends from your taxable account. They're already taxed or going to be taxable income, so you use that. Or maybe you're at the RMD age, and so you've got required minimum distributions out of your IRA, and so you can use that. But short of that, you're going to have to make some tax decisions. And the thing I want to point out here is that you may pull from one account and rebalance from another, or you might pull the money from more than one account, right? 2 or 3 different accounts, depending on your tax situation, and still rebalance from only one of those accounts, or with a totally different account. And let me give you an example. Let's say in a year you want to pull entirely from the Roth account because you don't want to incur any additional taxes in a given year, And if you're like me, the Roth is 100% stocks. So when I pull from the Roth account and move the money over, it could really mess up my asset allocation. Also, depending on what the market has done since the last time I rebalanced, but that's okay. Hopefully, I can go into the IRA here and rebalance. Maybe I'm selling bonds to buy stocks, whatever it requires to get back to this 60-40. The point is, in this example, I've used the Roth account to actually fund bucket one. And then I've used the IRA to do the rebalancing without any tax consequences. I will say, whether you use the bucket strategy or not, one thing that I've found that makes all of this much, much easier from a tax perspective, if you can manage this, is that to have a traditional IRA that has both stocks and bonds in it. So that if need be, you can sell bonds to buy stocks, you can sell stocks to buy bonds, and you can do that regardless of where you pull money from to put it into your checking account to spend for that quarter or that year. All right, so that's bucket one. We haven't even gotten to trying to model this in say, Bolden yet. We'll come to that. But that's just the simple bucket strategy. When we get to the 3-bucket strategy, it gets much, much more complicated. And let me pull up a clean sheet here. Let's see. Here we go. So with the 3-bucket strategy, we have, and here again, my really bad buckets, but here we go. We have more decisions that we have to make. What do we have to decide? Well, the first is what we're going to put in each bucket. Now, one approach, the simplest, I guess, is to put cash here, bucket 1, bonds in bucket 2, fixed income, and stocks in bucket 3. Right? I will tell you that when I talk to people that use the bucket strategy, it's almost never this simple. They'll put some stocks in bucket 2, for example. I've seen people put stocks or certain kinds of bonds in bucket 1. They might not have 100% stocks in bucket 3, and that's going to complicate things, as you might imagine. For our purposes, I'm going to keep it simple: cash, bonds, and stocks. So the next thing we have to decide is how much in each. And so what I've seen is that people tend to put 2 to 4 years in the cash bucket. And then it just depends, but I'll say 5 to 8 years in bonds. And then the rest goes in stocks. One thing to note that I find interesting is that a lot of times when you add up the cash and bonds, when I look at other YouTubers that follow this approach or articles I've read, they tend to add up. If you were to add these two together, they tend to add up to roughly 10 years worth of expenses. Now, if you're assuming you're spending about 4% a year, times 10 gets us to what? 40% in fixed income, including cash. In other words, it gets you to our well-known 60-40 portfolio. You kind of end where you started. It's a 60-40 portfolio. We've just complicated the matter now by sort of breaking it into buckets. Okay. So why do people do this? First of all, the theory behind it is, hey, we all know about the sequence of returns risk. That's the risk that stocks will do very poorly in the first 10 or 15 years of retirement. Inflation could be bad. And so the theory is we can spend down the cash bucket and even spend down the bond bucket because we don't want to sell stocks while the market is down. And this is going to give us a big cushion, 10 years worth of, we could suffer through a bad market for 10 years and not have to touch our stocks. That's sort of the thinking behind it. Now, one comment here. We talk about the 4% rule and other spending rules. The 4% rule is in and of itself a way to address the sequence of returns risk. In other words, you're addressing it by starting with, frankly, an extremely low withdrawal rate, a withdrawal rate that was, if we look back 150 years in the U.S., that was the worst outcome. It's for folks that retired in the mid to late 60s. So in one way, we're already addressing the sequence of returns risk if we don't take too much out of our portfolio. But I guess the theory behind the bucket strategy is this is sort of like a second layer of defense, 10 years worth of cash and fixed income. Again, you get the same thing with the 60-40 portfolio, but some people just like to see it this way. Okay. But now the question becomes, and this is going to get us to retirement planning software and some of the problems. How do we decide when to move money from one bucket to another? With the Harold Avinsky 2-bucket strategy, it was simple. Every quarter, you just move from bucket 2 to bucket 1. Well, we could do this on a quarterly basis. That's fine. But we'll look at it from a yearly basis just because maybe it's a little easier to think about it that way. But we can imagine after a year, I'll just draw a line. Our cash bucket's low. It was up here when we started the year. And let's assume we've, I don't know, got 4 years in there or whatever. And we spin it down. So now our pail, it's not empty, but it's gotten lower. So we could top it off with bonds. But then that's going to probably make the bond bucket lower. Maybe it had some returns the previous year, so maybe not dollar for dollar, but we're probably below. Let's just say our target, for sake of discussion, we'll just say it's 7 years. What if we're below that? Well, I guess we top it off with stocks, right? But if you think about what we've just done, all we've really done is moved money from stocks to bucket one. I mean, we've done it in 2 steps instead of 1, but all we've done is moved it from stocks to cash. And if we do that every year, all we're doing is effectively spinning down our stocks every year, which is exactly what the bucket strategy is intended to avoid. So what a lot of people do is they come up with rules. So this is just another thing we need. So we need to decide what goes in each bucket. We need to decide how much years worth of expenses for bucket 1 and 2. And now we need to come up with some set of rules. One of them I've heard is to say, well, listen, if stocks are down, we'll just ignore bucket 3. We'll leave it alone. We don't want to sell low. And we'll just use the bonds to fill up bucket 2, and we'll let the bond bucket get lower each year. And we got 5 to 8 years in there. We got plenty of time. And I suppose if bonds were down, we might even let the cash bucket get low. And we'll just wait it out. The S&P 500 was down 3 years in a row in the tech bubble burst. It was down 4 years in a row in the Great Depression. So the thought is, look, boy, we got 10 years. We can ride out any storm. I think that makes some sense. I think it's logical. I would point out that if we go back to the Harold Ivinsky 2-bucket strategy, remember he's rebalancing back to, in the hypothetical I use, 60-40 every quarter, every year, whatever you might do. So if stocks are down, you're going to actually, not only are you not going to end up selling stocks, you're going to end up selling bonds and buying stocks. So the regular portfolio based on percentages already protects us and doesn't force us to sell stocks. Remember, what funds you sell to actually move money into your checking account isn't the issue. You can sell stocks even in a down market to move them over to your checking account because you want to take out of a Roth, for example, and then immediately rebalance. So you're selling bonds to buy stocks back. The net result is not only have you not sold any stocks, you might have actually been a net buyer if the market was really down. So we already do that with a regular portfolio. With the bucket approach, we're not actually buying stocks. Now, I suppose someone could say, well, wait a minute, Rob, this doesn't always have to flow right to left. Whoops, I'm erasing. Why am I erasing? Hang on. Here we go. It doesn't have to flow right to left. We could, if stocks are down, we could move money this way. Okay. But now that's another rule you need to come up with, and I'm not sure why you would do that. You could have just started with a 60-40 or 70-30, and it was very simple, all right? So you can see the complexities, and we haven't even gotten below this bucket strategy to look at real-world accounts. And that particularly becomes a problem if you mix and match what you put in each of these buckets. So maybe you have stocks and bonds in bucket 2, and stocks and bonds in bucket 3, or multiple asset classes in bucket 1. You've got to figure out, you've got to map all of that to, remember, the real world taxable account and the real world IRAs and HSAs and Roths and so on. So it can become really, really complicated to do all that. You can do it if you think it's helpful to you. When we move over to retirement planning software, the big issue is this. When you've got a 60-40 portfolio or whatever, and you're rebalancing periodically, your allocations don't deviate much from that plan, say 60-40 as an example. If you follow the bucket strategy, and I ran some numbers, your asset allocation can change significantly. If we went through the tech bubble burst where it was down 3 years, and you just ignore stocks when the market's down, it's going to get lower and lower and lower. And remember, you're not buying back because you're not rebalancing. Now, you're not selling stocks, good, but you're not rebalancing with the bucket strategy either. You're just spending out of your cash bucket and your bond bucket. And so your asset allocation, if it started at 60-40, it could easily get to 50-50 or lower. Or maybe you have really good years. You're topping off the cash and bond bucket from stocks because markets are going up, but they've gone up so high that now your stock bucket's overflowing. Good problem to have, right? But if you started at 60-40, you may end up at 70-30 or 75-25. And that actually creates a problem, maybe not the end of the world, but a problem for retirement planning software. And let me show you what I mean. So this is Bolden. This is a demo account. And I actually started to set up some accounts here where you can see right here as an example. Traditional IRA bucket 2. And then I have traditional IRA bucket 3. So these are just names, right? You can call this name whatever you want. And so I just took them and added bucket 3 and bucket 2. And the theory behind these two accounts was, let's imagine we had $500,000 in an IRA and half was stocks and half was bonds. Well, the bonds would be part of bucket 2. So I just create a separate account here. Because remember, in retirement planning software, including Bolden, these accounts don't have to map one-to-one to your real-world accounts. And there could be good reasons not to do that, even beyond the bucket strategy. For example, you might want to break out your taxable account into any number of accounts within Bolden because maybe your investments in that account have significantly different capital gains exposure, right? In any event, so what I did was bucket 2 for the bonds and bucket 3 for the stocks. And it's very easy in Bolden to move money from one to the other. So let's just imagine one year we wanted to move $25,000 from bucket 3 in the stock bucket to bucket 2, as part of our plan. We would come down to money flows. We could create a transfer. I already created some, but I'll create a new one just to show you how easy it is. We got our buckets here. I didn't convert all of them to buckets, but this would help us find the right account. There's our bucket 3 account. It's going to go to bucket 2, and we could put the amount in. It's one time, and we'll just say it's maybe we're going to do this. We figured it out. We're going to do it in January of 2025. And there you go. And it makes changes. It recalculates all your numbers, and it's very simple. So you might say, well, Rob, that's easy. What's the problem? Here's the problem. You won't know ahead of time what money you're going to move from what bucket. Right? We don't know if stocks are going to end the year higher or lower. I suppose, I won't even say they're going to end higher. They're up about 20%, but that would just jinx us, right? We have no idea what money we're going to move from what bucket to the next at the beginning of next year, let alone 5 or 10 years from now. There's absolutely no way we can model that kind of bucket strategy, I think, in any retirement planning software. Again, as you saw with Bolden, it's easy to create the account. It's easy to move money from one account to another. That's not the problem. The problem is we have no idea ahead of time what account's going to have how much money. Now you might say, well, wait a minute, Rob. In a 60-40 portfolio, let's keep it simple, you could have the same problem because you don't know exactly how much money is going to be in which account. It's going to depend on which account you decide to pull from a tax perspective. You can model that in Bolden. You can even easily change the withdrawal order now. But you don't know for sure what that's going to be. You don't know what the market's going to do and how you're going to move money from one account to another. And the answer to that is you're absolutely right, and I don't think we need to. So if I were going to use the bucket strategy in Bolden, I wouldn't bother with it in terms of calling accounts. You could call accounts bucket 1 and 2 and 3 if it just helped you see it. But I would absolutely not be thinking about modeling transfers from one bucket to another. I would probably once a quarter, maybe even once a year, I would update the balances. I would just go in, update all the balances, and that would be that. The problem you'll have with the bucket strategy is that for each of these accounts, let me close that, as you can see here, I'll just use this as an example, you have to set the optimistic rate of return and the pessimistic rate of return, and then Bolden calculates an average. The problem is you won't actually know what that's going to be with the bucket strategy. So I'll use tools, and we've talked about this before, where based on your asset allocation, you can get a rough idea of the long-term performance of that kind of portfolio. Obviously, there's no future guarantee, but you can use that as a rough estimate. The problem with the bucket strategy is your actual asset allocation could be jumping up by quite a lot, certainly in market extremes. If you're rebalancing every quarter, twice a year, once a year, it's not going to move in that extreme way because you're going to be bringing it back to your plan. But with the bucket strategy, at least the 3-bucket strategy, that's often not what you're doing. So what asset allocation you have could suggest a rate of return that's very different than what you have in the software. And you're not going to know ahead of time what that's going to be because you're not going to know which buckets you're going to be pulling from. Now, some might shrug their shoulders and say, well, I'll just use my best my best estimate based on my asset allocation as it exists today. And you're right, Rob, using the bucket strategy, that could change a bit, but I'll just keep the balances updated. Eventually, it should kind of get back to some kind of 60-40, 70-30 portfolio. Maybe the planning will be off a bit, and that's okay. You'll get no argument from me. It might be okay, but at the end of the day, you do have to recognize that with a 3-bucket strategy, your actual asset allocation could change and change significantly, particularly when the market is up a lot or down a lot. And those changes might not be so easy to reflect in retirement planning software. I suppose you could calculate your asset allocation once a quarter and go in and change all of the assumptions about rates of return going forward, but it's just going to change again in the not too distant future, and I guess you're going to have to go back in and keep changing them. I'm not sure I would do that, but I suppose it's one way. Beyond that, I don't think I'd even try to model the bucket strategy in retirement planning software. So that's my take on what seemed like a very simple question. It probably also underscores why I'm not a big fan of the 3-bucket strategy. Now, maybe you've come up with a simple solution to all of this, and if you have, I would love to learn about it. So leave a comment below this video and let us know how you do it. Until next time, remember, the best thing money can buy is financial freedom.